Amazing. Thanks for coming. I feel like most people probably just made it to the event by noon. This is like the earliest that you can reliably count on people here for. So the topic is how to earn passive income with crypto. And we were just talking a little bit here of, it's almost a bit of a misnomer because there is no passivity in DeFi right now. There's so much that you need to be monitoring, you need to be watching, you need to be analyzing, and it all happens at machine speed. And we're, big smart monkeys it's really challenging for us to operate at machine speed. So how do we create the technology? How do we find the right service providers? How do we protect ourselves in DeFi land? Because honestly, DeFi is fantastic. It is everything that is traditional finance with all of the unconscious biases, all of the unknown business processes, all of those things, but written out in zeros and ones. It's beautiful, it's clean, it's fantastic. It's really kind of an evolution of the whole state of finance in general. But when everything's written out in zeros and ones, it's gameable. It's like when you create an Excel model that's circular and you connect the last little thing and you don't do it right and everything refs the hell out. That's sort of where we're at in DeFi right now. It's a really wonderful experiment and it's really, really cool, and we're creating all sorts of magic, and there's really, really interesting parts of it. And if you do it right, you can make a ton of money, and that's great. And there's a whole bunch of really fascinating experiments that are happening in it. But we can't abandon kind of the traditionals of fundamental risk management that sort of goes into this whole thing. So what we're going to be talking about a bunch today is sort of risk management frameworks around DeFi, which especially in kind of the wake of UST is really, I think, where we need to be focusing. So I'm actually doing 2 sessions today. I'm going to be doing one right now on bigger, broader, and then I'm actually doing another one at 4 that I'll actually be going through a live demo of how to buy DeFi insurance. Walking through a real transaction, how to file a claim, how to actually manage it, how to watch your policy, all of that fun stuff. But let's dig in. So can you truly be passive with events like this? So what we have on the chart here is a histogram of whale activity and withdrawal activity on Anchor. And so you can see giant spike of activity, predominantly dominated by gigantic transactions, the biggest one being a $346 million withdrawal. And it preceded the depegging event by about 20 minutes, 45 minutes. This is at 1 a.m. Eastern time. Can you really be passive when stuff like this is happening? So we're not going to get into who this was, whether this was intentional, all of that stuff, because that's kind of a whole separate topic itself. But if you're clipping your 20% in a protocol like Anchor, you need to know about stuff like this. This is very material to your risk management structure. And there's a whole bunch of ways that we'll talk about today of automating this. If everything is happening at machine speed, you need to have the machines working for you. So can you truly be passive when things like that happen? And the answer is yes, but you need to be very careful and thoughtful and practical about it. And step 1 is know your experiment. This is all a gigantic experiment, and it's fascinating, and we love it. It's all open source. Anybody can get in. You can quit whatever you're doing before and just start doing stuff, which is the magic of blockchain and DeFi in general. But everything was an experiment in 2015 to 2018. Tether, early USDC, DAI, new bits, which probably most of you have never heard of, early algorithmic stablecoin that trades for 1 cent today. It was a whole bunch of, let's figure out a way to kind of bootstrap some stability into this madness world. And we've really sort of separated between the two in kind of modern times. There's an evolving part of experiments, UST, magic internet money, which is great for a stable coin. Neutrino, Tron, all of these things are still evolving experiments. They're ways to kind of try and create capital efficiency and bootstrap capital efficiency into crypto land. DAI is fantastic because it is stable, but it's over-collateralized. It's wildly capital inefficient. There's a whole bunch of these things that are kind of working on ways to create a better model for capital efficiency. And then there's things that are kind of ready for prime time today. USDC, fantastic example of it. The reserves, what they're working on, how their regulatory structure is great. We're working on a product out of Canada called VCAD that's actually tokenizing a deposit receipt within a Schedule I bank. So basically creating an A-rated stablecoin. Paxos, fully reserved. Like those are the things that are kind of ready for mainstream adoption. But that's today world, and we really need to continue to experiment and continue to build these new models. And so when we think about, okay, well, UST blew up and there's a significant amount of capital is wiped off the map, that is objectively challenging for the industry. But we need to be sort of looking at what is a stable coin, what's ready for prime time, what's ready for public consumption, what's ready for payment use cases, remittance use cases, what's ready for that, and what's still an experiment. And we need to be able to keep looking at what is a good experiment and be able to keep experimenting, because that is the magic of DeFi and blockchain right now. But the headline thing to take away is an algorithmic stablecoin equals $1 because of a bunch of weird, novel experimental math. USDC and VCAD equal $1 because there's $1 in a bank account and you're putting a little bit of technology on top of it. And those are very, very different things. So step one to managing your risk in DeFi is knowing what your actual underlying is. There's a very different value proposition between staking MIM on Curve versus staking USDC or lending USDC to Compound. Know your counterparty. Yeah, we actually will dive in a little bit to CeFi on this, because CeFi is sort of this forgotten middle child in the evolution towards an all DeFi world. And CeFi is basically, I said it before at the start, of there is a traditional financial institutions that have very opaque business processes, very opaque structures, very opaque ways that they make money, and traditional people can't participate in it. And then DeFi, which is completely transparent, blah, blah, blah. CeFi is really sort of an interesting hybrid of the two, where you're taking some of the functions that were traditionally used only by securities lenders, only by deep subs of gigantic financial institutions, and you're bringing them more into the light, but not quite as much as DeFi world. So, but you don't have the transparency in CeFi land. But this is one of the things that we really paid a lot of attention to in 2018 when we first kind of started this is, okay, but these are basically acting as securities lenders or banks, so why don't we analyze them like securities lenders or banks? So what we've kind of done is basically look at the credit quality of all of these counterparties that we're lending to, whether it's Celsius, Genesis, Galaxy, Coinbase, all of these, they have a credit piece to their component. So we built kind of a model that basically looks at the balance sheet side of it and then the profitability side. And we won't go too deep on this, but you can kind of look at the Moody's S&P or Moody's rating structure for banks and really take some of those things and layer them on to traditional counterparties. So asset risk, what's the credit quality of your book? Capital risk, how much credit do you have, or how much equity do you actually have as compared to the size of your book? So you can start to look at capital adequacy requirements, a lot of the Basel III stuff that applies to banks, and how does that apply to CeFi companies? Profitability, how quickly can you rebuild your balance sheet if you lose several $1 million on UST or some other tail event in the DeFi world? And then how you're matching assets and liabilities. I mean, everything in crypto is wildly liquid, and that's really the entire point of it. But if you have a whole bunch of assets on your balance sheet that's staked in STETH or staked in waiting for the merge to happen, but you're offering liquidity to your front end, that's a real challenge. So how quickly and how tightly are those two matched? So really think about kind of when you're looking at counterparties and when you're looking at the people that you're giving or lending money to, really think about and kind of put on your traditional financial management hat and start asking some of those questions. And the transparency is hard to find. Like especially the retail side don't necessarily give out financial statements. There's challenges in that. But when you send assets into them, look on a block explorer. You can see your assets flowing into that platform. You can see all of the other assets that are floating around in that platform. You can create these kind of wallet maps and actually follow your assets in, and you can start to learn some really, really interesting things about these platforms. So flipping the switch a little bit, taking this kind of model of layering on traditional credit analytics to CeFi companies, look at DeFi companies. I said it again, and this is going to be a consistent theme for this, is there is DeFi companies are just recreating existing financial structures in a completely transparent way. We've used a whole bunch of new terms, but there's still basically the exact same things. So what we've got here is a snapshot of the Compound front end. so what you would actually see on their app, and then a little bit of reimagining or remerging into what is more of a traditional balance sheet type. So you can see what their liquid cash is. You can see what the borrow and collateral ratio is against all of their exposure. You can imply what the rehypothecation ratio is, because that's a really interesting concept. In DeFi, everything is rehypothecated. In CeFi, that's still kind of a dirty word of, oh, I'm posting collateral, why are you relending it out? But that's one of the core concepts of DeFi. So you can start to really create kind of these maps of which platforms have the right leverage ratios. Which platforms have enough liquidity in them, which platforms have the gigantic rehypothecation ratios, and start to kind of run these traditional credit metrics into DeFi platforms. I talked about this a little bit before, the Batman machine. Every transaction that's ever been done on any network ever is available to you. That is wildly powerful. Yes, they're done in hashes, they're done in anonymity, but that anonymity is pretty thin. You can find, especially if you particularly are sending assets into a platform, lending money to a counterparty, you already know that that is their asset. And every transaction that that wallet has done is available to you. Use your Batman machine. Follow your assets in, start mapping out wallet clusters. Some of the stuff you're seeing on stage here is basically some technology that we built at a sub of my company called Yield as a Service, where whenever there's a counterparty, we map their wallets, we map their wallet clusters. We have a kind of a real-time view of, okay, what is your asset base? What is your asset structure? If it's all USDC and all stablecoins, great, low risk. If it's all Doge and all a bunch of lower than 100 coins, that's a different risk profile. And both are fine. Like, that's the business model. There's money and arbitrage to be made in all of those things, but you need to know what it is. And especially when it comes down to, if you get financial statements and you just see a line that says like crypto, that's not how the world is. That's not how cryptocurrency works. There's wildly different risk profiles in all of these underlying pieces. So what we have here on the top left is basically an exposure map of a traditional counterparty, where we look at, once you follow them in and create the wallet cluster, you can really basically create a real-time balance sheet. So all of their net transactions that are borrowers, all of their net transactions that are lenders, from all of these wallets that they use, and you can almost create kind of a real-time lend book. And then you can start mapping out what the risk profiles of all of those borrow and lenders are. So if there's a $1 billion loan book and it's all USDC, again, that's one thing. If there's a $1 billion loan book and 500 million of it is the Doge to a one random wallet, that's a completely different risk profile. So what we have here is this one gigantic wallet in one of our counterparties that has a higher risk profile and is clearly an outlier. And then you can kind of double click into those wallets and follow them around. So when we have this idea of the Batman machine, I mean, it's literally unlimited transparency. You just need to know where to start. And when you do start and start pulling strings, the amount of stuff you can find and learn is unbelievable. So use your transparency, use the information that you have for you, build real-time alerts for when there's major transactions that are happening between these wallets. And a lot of this stuff is our job as service providers in the industry to build the solutions that are easy for consumers of the industry as well. DeFi, very similar. It's actually even more transparent and even easier to use. This is a breakdown of one of the big transactions that happened in the early Terra meltdown. So there's an $85 million withdrawal from Anchor, went through the wormhole over to ETH, and then dumped into the pool, the three pool within Curve. That happened to time up with another major transaction that happened that was 150 million from the LFG. And you can see all of this stuff. You can do these analytics. You can do them in hindsight, which is fun and fascinating, or you can do them in real time, or you can have platforms that do them in real time for you. But just like my first slide where it says, hey, you need to know when major things are happening, again, there is unlimited transparency in the space. It's all about data processing, data provision, and really kind of working towards making machines work for you. Because the entire world is trying to exploit all of these systems all the time, and you can't monitor that yourself. So we need machines to help you. Protect your neck. CeFi world. Collateralization. In retail platforms, basically doesn't exist. And when you look at the terms and conditions for a lot of the retail platforms that people are deploying to, it's not a great legal foundation. It's not a deposit. It's not really a loan. It's more kind of a gift that you get rewards for. And that's, again, that's fine. It's liquid. You can take it out at any time. There is a model. There is a way that they're kind of building the business model. But you need to understand that side. On the institutional side, and what is becoming more and more prevalent, particularly as we go through the market cycles, is collateralized lending. So generally when we deploy, we're looking for Bitcoin to come back to us to basically secure that loan. And that, it's not the default, but if you're not doing that, then you really need to rely on that credit quality analysis that you're doing on the underlying, because that's basically your bottom line. If you have over-collateralization, and this is how the whole DeFi world works right now, is you don't need to underwrite to compound. You just show up with a bunch of money and be like, I'm good. Here's my 150% ETH. There's a really, really solid base of highly liquid collateral in Bitcoin, and Bitcoin is a wonderful collateral. Trades 24/7, you always have real-time looks into the value of it. It's easily fungible, easily liquid. It's way better than the majority of collateral that's taken in securities lending or in traditional banking. Like a house is much more challenging. But you need to monitor it. And the way that Bitcoin trades is if it tanks at 3 a.m., then you're underwater. And there needs to be kind of these structures that are built that automate your monitoring of that. So even when you are in CeFi land and you are in kind of this a little bit more traditional style, collateralization is a really, really powerful and effective way to manage and mitigate your exposure. And DeFi. So I'm not going to do the demo right now. I'm going to do it in the next session at 4. But DeFi insurance is absolutely fascinating. It's one of the least explored areas. Everybody's highly, highly skeptical of it, and for good reasons. This is not Lloyd's of London. Platforms you may have heard of, Nexus Mutual is probably the most regulated one. Unslashed is the one that I'm actually going to do a demo of. And we recently had a really, really interesting and ultimately successful experience with the Unslashed platform. So whenever we take DeFi exposure, similar to how we collateralize our CeFi loans, we take insurance policies against them. And it's a great experiment. All of this is a great experiment. And it was always, what's going to happen? UST depegged, we claimed on our insurance policy. And it was absolutely fascinating. And ultimately, the way these platforms work is, if you are a traditional insurance company, is basically they are a company with a ton of capital. They're selling you bets on events that they think won't happen at a very, very well calculated amount that they make a ton of money. And if there's a huge claim, then it is what it is. DeFi insurance protocols, just like all of the traditional financial insurance or financial products that DeFi is replacing or DeFi is evolving, are the exact same thing, except anybody can make that bet on the other side. So anybody can bet that UST won't depeg, or that there won't be a smart contracts hack on Compound, or that there won't be all of these things, and they put capital into it. But on the other side, if people are buying that insurance, just like if the Compound ETH pool or USDC pool is empty, you can't pull your capital back, it needs to be refilled. Once people have bought out the entire insurance that capital providers have done, you can't pull your capital back. So when there's an event, it's not highly liquid, everything kind of gets locked down. And then it goes into the claims process, which is this whole own fascinating thing, and a really cool example of decentralized governance. But ultimately, DeFi insurance is real. It takes careful review of the policies. And again, these are not Lloyd's of London policies. They're 4 pages that have lots of murky language and interesting concepts. But it's also, again, it's not Lloyd's of London. There's no monolith that's saying you are wrong and you are right and this matters and that doesn't. It's all community driven. So if you think the policy is wrong and you think that you have a valid claim, go to the community with it. Make your case. And ultimately, it's up to you and the community that governs all of this magic. So it's been a really fascinating experience in the wake of UST and in the wake of the aftermath of all of this kind of chaos in the DeFi and CeFi market to really see how all of this risk mitigation stuff works. And it does work. There's ways to do it. It's challenging. It requires a lot of tech or a lot of partners, but there's ways to do it. And it's really kind of my key takeaway to this is start, deploy, put what you can lose in, follow your money around, and try and be as safe as possible where you can be. I'm going to leave 9 minutes for questions, and then I'm going to do the full DeFi insurance demo at 4 p.m. But thanks a lot, guys. Appreciate it. Yeah.
Go for it.
For sure. You want to come up to the mic?
Yeah, like after the UST, huge crash, I think like there's some obviously fear within not only institutional investors but mainly retail investors, and you see a lot of projects come out with high APYs like Anchor does, right? Like, what are some of the things that? Sorry.
Joe, step up to the mic.
Oh, sorry. Yeah, so I was talking about the UST depegging and how a lot of fear has come from that. To get into DeFi as like a retail, even an institutional investor, what are some of the key learnings that at least you have learned from, like, that you can pass on to retail and institutional investors with new protocols coming out with high APYs and just not repeating history? What are some of the things that you talk about?
Yes. So we are creating a more efficient, more transparent, different world with DeFi, but it's not magic. So when there's things that are magical looking, they're probably not sustainable. And so, what we always try and do is really look at, there's real arbitrage and there's real opportunities, there's real trades, there's real fundamental value, there's real economics in the CeFi and DeFi and crypto space. But those are a subset of the economics that are available to you when somebody's promising 20, 30, 40, 50%. And what is the rest of those economics? And again, it's fine to play in those super high economics places, but it's an experiment. And so when you kind of look at what is the traditional world offering in old world boring finance, baseline. What is this offering in kind of new world, interesting kind of fun stuff? Baseline 2. What is the crazy yields that are there? And really we need to be sort of processing those like a venture investment rather than a fixed income investment. Because there is a couple of percent, maybe, I don't want to get too specific on it, that is just a more efficient, better way of using capital. I mean, banks take out, their net interest margin generally is 2-3%. DeFi platforms take a fraction of that. There is just a more efficient flow of capital from investors to deployers in DeFi in general. But when you're looking at 20-30% yields, there's something else that's happening. And whether you're kind of relying on reward coins that you're monetizing to make up a portion of that and kind of the yield farming structure, again, that's fine. But if everybody is selling, who's buying and what's the buy side fundamental value proposition? And if you can't put your finger on that, again, that's fine to play that and to do that side, but you really need to think about from a sustainable economic side, where is the value proposition actually coming from this? So I think like a straightforward use of Compound or some of the high wall clock DeFi platforms, that you can get your head around why that's happening. There's a real economic value transfer that's happening there. It's over collateralized. It's straightforward on that side. When you start to get into some more esoteric stuff, it's harder to kind of trace that all the way back to where is really the core value. And I'm not saying there isn't core value, but it's an experiment. So take it with a big grain of salt, be careful, and really, really, really watch yourself.
Can you be more specific about the spread between the lending and borrowing seems fairly straightforward in terms of how you generate return?
Yep.
And some of the other things that you're describing, which are either maybe magic or very complicated, can you give an example of like how yield is generated and it's not just the spread between the lender and borrower?
Sure. So a great example is like AMM and liquidity provision. So there's and always kind of my point is these are all functions that were usually done by deep subsidiaries gigantic financial institutions. So market making and liquidity provision is something that's been done forever and ever and ever, of providing liquidity, making sure spreads are tight, not needing to match directly order books, and basically making a market around it. And what DeFi has done, so Curve, Uniswap, any of the big AMMs or automated market makers out there, they basically decentralize that. So anybody can put in capital, anybody can provide liquidity and make markets now, instead of just having gigantic financial institutions do it, which is awesome. It's democratizing finance. It's allowing a ton of access to value propositions that used to only exist to giant institutions. But there's risk to it. So the way that AMMs and market makers work in general, you put in both sides of the trade, and so if it's a USDC to ETH pair or something along those lines, you'd put in both sides of that trade, and basically provide kind of a bid for the actual market. So, and you get paid a fraction of every transaction that happens in that pool. So there's a fee or liquidity fee that somebody would pay to do an ETH USDC trade on Uniswap, and you get paid a fraction of that if you're providing some of the liquidity around it. So if you put in $1,000 of capital and you're clipping transaction fees on an ongoing basis, then you're earning effectively a yield on the $1,000 of capital that you put in. Where kind of the magic part is you're also earning governance tokens or earning reward tokens for those platforms, because all the platforms want to incentivize usership on their protocol. So you're earning Uni tokens, you're earning compound tokens, like you're earning all of these other tokens, and you can go into the market and monetize those and basically say, okay, I put in $1,000, I'm earning $5 of transaction fees, which is sort of the core economic value piece, and $5 equivalent of Uni tokens or comp tokens or whatever. And when you start to sort of stack all of those things together is where you get into these like 30, 50, 80% APYs, but a bunch of that APY is monetizing of those tokens that you're getting, which that sort of is the more challenging value proposition. So there's sort of the real fundamental value of providing liquidity to a pair, and then the token that you get and monetize, which is sort of the farming part of yield farming, that's a little more challenging to get your head all the way around the economics of. Yeah, absolutely. So questions about DeFi insurance and brands and the spread of it. So one thing to make very clear, this is not a company offering DeFi insurance. This is a protocol and basically a DeFi platform itself. So the Unslashed is a great one, a little bit smaller. Nexus Mutual is actually a regulated mutual fund or mutual trust out of UK. So they're another one that is interesting and very cool. Insure Ace is a good one. Risk Harbor is another one. So it's a nascent-ish market. It's been really tested in the last month or so with all of this stuff with UST, and it's a really cool place to watch. It depends what you buy, right? So you can cover whatever exposure you have, but you need to prove loss. So and generally the kind of the protocols or the policies are about depegging risk. So there's insurance on all of the algorithmic stablecoins, or smart contract risk. So if a smart contract gets penetrated on Compound, whatever, any of the other platforms, Uniswap, whatever. There is actually some CeFi insurance as well, which is interesting. But the depegging is easily provable. It depegged. There it is. Smart contract attacks are much more challenging because it's basically, is this an attack? Is this just a flaw in the logic? Like how do you prove that? And how do you make that kind of case? So it's read the policies, and again, I'm going to do kind of a full overview at 4 p.m. I've got 5 seconds left, one more. CeFi is centralized finance. So Celsius, Galaxy, Genesis, like all of the companies that are doing this stuff, TradFi, traditional banking, CeFi kind of a hybrid between the two, and then DeFi is this purely decentralized, all on-chain stuff. So it's not quite as black and white as that. Everybody kind of plays in the middle, but yes.
Yeah. Thank you so much, Alex. That was really fascinating. And thank you, everyone, for coming. I hope you can stick around and answer a couple questions, and you'll be back at 4. So
at 4,
continuing
exactly.
on, I know there's a lot of interest in this and a lot to unpack. So do come back at 4 and come early so you get a seat and a space in this room.
Amazing.
This is a standing room only. So thanks again.